On a spring morning in April 1720, Isaac Newton sold his shares in the South Sea Company. He walked away with £7,000 in profit, a fortune by any measure. Newton was 77 years old, the most famous scientist in Europe, and he had just made a smart decision. He recognized that South Sea stock had risen too far, too fast. The price had doubled in 3 months, with no change in the company's actual business, so he sold. And then he watched the stock keep climbing. £550 per share in May, $700 in June, $890 in July, $1,000 in August. Everyone around Newton was getting rich. His friends, his colleagues at the Royal Mint, people he considered far less intelligent than himself. They were all holding South Sea stock and watching their wealth multiply. Newton couldn't stand it. In August 1720, at the absolute peak of the market, Isaac Newton bought back in. He invested £20,000, nearly his entire life savings, at prices 4 times higher than when he'd sold. 6 weeks later, the stock collapsed. By December, shares that had traded at £1,000 were worth $124. Newton lost everything he'd reinvested. When asked about it years later, he offered only one explanation. "I can calculate the motions of heavenly bodies, but not the madness of people." The man who discovered the laws of gravity, who invented calculus, who explained the orbits of planets, couldn't explain why he'd bought a worthless stock at its highest price. But Newton's failure wasn't about intelligence. It was about pattern recognition. The South Sea bubble followed a specific 5-stage fraud pattern that has been repeated in every major financial scam since. Enron, Madoff, Theranos, FTX. Different centuries, different technologies, identical structure. If Newton had recognized the pattern, he would have known that August 17th, 20 was stage 3, and stage 3 is always followed by collapse. The South Sea Company was born from government desperation. By 1711, Britain had been fighting the War of Spanish Succession for 9 years. The costs were staggering. Britain's national debt had reached £9 million, roughly $1.5 billion in today's money, and the government couldn't pay the interest. A group of merchants proposed a solution. They would create a new company, the South Sea Company, which would assume Britain's national debt. In exchange, the government would grant them exclusive trading rights with South America and the Pacific Islands. The pitch was irresistible. South America was legendary for gold and silver. The Spanish had been extracting wealth from the continent for 2 centuries. Britain was negotiating trading access that would be formalized in the Treaty of Utrecht 2 years later. The South Sea Company would ship British-manufactured goods to South America, trade them for precious metals, and generate profits large enough to service the national debt while paying handsome dividends to shareholders. There was only one problem. The trading rights were essentially worthless. Spain still controlled South America completely. The treaty allowed Britain to send exactly 1 ship per year to trade at Spanish ports. 1 ship. And Spain took 25% of the profits, plus taxes on every transaction. The South Sea Company's founders knew this. They had read the treaty. They understood the restrictions made profitable trade nearly impossible. But they didn't build the company to trade. They built it to sell stock. The promise of South American riches was marketing. The real business model was convincing investors that the promise would eventually come true. This is stage 1 of every major fraud. An impossible promise that sounds plausible because people want to believe it. The South Sea Company promised access to unlimited wealth. Theranos promised blood tests from a single drop that would democratize healthcare. FTX promised a crypto exchange that would replace traditional finance. The specific promise changes. The structure doesn't. A promise alone isn't enough to create a bubble. People are naturally skeptical of opportunities that sound too good to be true. Stage 2 overcomes this skepticism by attaching the promise to institutions that people trust. The South Sea Company didn't just have a business plan. It had the British government. Parliament passed the South Sea Act in 1711, officially chartering the company and granting it a monopoly on trade. By 1718, even King George I had agreed to serve as the company's governor. Members of Parliament bought shares publicly and encouraged their constituents to do the same. The Chancellor of the Exchequer promoted the company as a patriotic investment. How could it be a scam if the king himself was the governor? How could it fail if Parliament had approved it? What the public didn't know was that the company's directors had distributed shares to politicians as bribes. Not officially, of course. The shares were recorded as gifts or loans that never required repayment. Dozens of members of Parliament received stock worth thousands of pounds. The King's mistress, the Duchess of Kendal, received shares worth £15,000. These weren't investments, they were payments for protection. Politicians who owned South Sea stock had personal financial interests in promoting the company and blocking any investigation into its actual business. The same pattern appeared with FTX 3 centuries later. Sam Bankman-Fried didn't just build a crypto exchange, he built political relationships. FTX donated over $70 million to political campaigns in 2021 and 2022. Bankman-Fried personally gave $40 million to Democratic candidates and causes. His colleagues gave millions more to Republicans. He testified before Congress as a crypto industry expert. Regulators invited him to help draft cryptocurrency legislation. When you donate enough money to enough politicians, skepticism becomes politically inconvenient. No one wanted to investigate the generous donor. No one wanted to question the expert witness. And when FTX collapsed, politicians rushed to return the donations and claimed they'd never really known him. Just like Parliament blamed the South Sea directors in 1721 while quietly keeping their own profits. Stage 2 is when fraud becomes respectable. When questioning the investment means questioning institutions that people trust. This is the most dangerous stage because institutional validation silences the people who might otherwise sound the alarm. By spring 1720, South Sea Company stock had disconnected from any rational valuation. In January, shares traded at £128. By March, £330. By May, £550. By June, £1,050. A 700% increase in 6 months. The company's actual trading operations remained minimal. Nothing justified the price. But rationality had left the market. The gains were real, at least on paper, and everyone who held shares was getting wealthy. Stories circulated through London's coffee houses about servants who'd bought shares and now earned more than their masters. About merchants who'd sold their businesses to invest everything in South Sea stock. About widows whose small investments had become fortunes. The fear of missing out overwhelmed the fear of loss. People who had never speculated before mortgaged their homes to buy shares. The mania spread beyond the South Sea Company. Dozens of imitators emerged, launching new companies with increasingly absurd promises. One company prospectus famously offered shares in an undertaking of great advantage, but no one knew what it was. The founder collected £2,000 in deposits in a single morning, then disappeared. Investors didn't care about business fundamentals. They cared about buying anything that might go up in value. This is the psychology that trapped Newton. He had sold in April at £300 per share, a wise decision by any rational standard. But wisdom provided no comfort when the stock reached 500, then 700, then 1,000. Newton wasn't watching strangers get rich. He was watching his friends, his social circle, people he saw every week at the Royal Society. They had held when he sold. They were now worth fortunes, while he had mere profits. The emotional torture of watching others succeed while you stand aside is almost unbearable. It overrides logic. It overrides experience. It overrode the greatest scientific mind of the age. Newton bought back in at £1,000 per share in August 1720. The peak. Stage 3 is when even smart people become stupid, because intelligence doesn't protect against emotion. And the emotion of missing out is one of the most powerful forces in human psychology. While Newton and thousands of other investors were buying at peak prices in August 1720, the people running the South Sea Company were selling. Company chairman John Blunt sold over £100,000 worth of shares between June and August. Other directors followed. They converted their stock into cash, gold, and real estate. Real assets that would hold value regardless of what happened to the stock price. They didn't announce these sales. They used intermediaries and spread transactions across weeks to avoid detection. Publicly, they continued promoting the company. They declared that dividends would increase. They announced plans for expanded trading operations. They had Parliament pass new laws benefiting the company, all while selling. The insiders knew what the public didn't. The stock price was built entirely on speculation. There were no profits from South America coming in. There never would be. The only question was when the market would realize this. By September, the first cracks appeared. Several smaller bubble companies collapsed. Investors started asking uncomfortable questions. If these other companies were frauds, was South Sea different? The selling accelerated, and selling created more selling. South Sea stock dropped from £1,000 in August to 150 by October. An 85% collapse in 8 weeks. The directors who sold in August kept their fortunes. The investors who bought in August lost everything. FTX followed the identical pattern. In the months before the November 2022 collapse, Sam Bankman-Fried transferred billions in customer funds to Alameda Research. He used customer deposits to buy real estate in the Bahamas, to make political donations, and to invest in other companies. He converted digital assets into real assets, all while publicly assuring customers their funds were safe, all while testifying before Congress about the importance of customer protection. When the collapse came, Bankman-Fried had real estate. Customers had account balances showing funds that no longer existed. $8 billion in customer deposits gone. The exit always happens before the collapse. The insiders always know first, and they never warn the public. In January 1721, Parliament launched an investigation into the South Sea Company. What they found was systematic corruption. The company's books were fake. Profits had been invented. Directors had bribed members of Parliament with free shares. The Chancellor of the Exchequer had personally profited. Even the King's mistress had been given shares to secure royal endorsement. The entire scheme was corrupt from the beginning. Parliament was furious. Not at themselves, at the directors. Several were arrested. Their estates were confiscated. John Blunt, the chairman, was stripped of his wealth. But the government officials who enabled it faced few consequences. A few resigned. None went to prison, because holding them accountable meant admitting the government had created the fraud. So Parliament blamed the company, called it an isolated case of greed, and moved on. Isaac Newton never recovered financially. He lost £20,000 and never spoke of it publicly again. When asked about the South Sea bubble years later, he would only say, "I can calculate the motions of heavenly bodies, but not the madness of people." The pattern repeated exactly with FTX. Sam Bankman-Fried was arrested in December 2022. He was charged with wire fraud, securities fraud, and money laundering. In November 2023, he was convicted on all counts, but the politicians who took his donations claimed ignorance. The regulators who praised his testimony said they had no idea customer funds were being misappropriated. No regulator was fired. No politician faced investigation. The fraud was blamed on a single person, and the system remained unchanged. This is always how Stage 5 ends. The public face of the fraud is punished. The institutions that enabled it escape, and the conditions that created the fraud remain in place, ready for the next time. Isaac Newton spent his final years avoiding any mention of the South Sea bubble. He had lost £20,000, the equivalent of roughly £4 million today. More than money, he had lost his belief in his own judgment. The man who calculated planetary orbits couldn't explain why he had bought worthless stock at its highest price. But Newton's failure wasn't a mystery. It was a pattern. The same pattern that would repeat with railway stocks in the 1840s, with Enron in 2001, with Madoff in 2008, with Theranos in 2018, with FTX in 2022. Stage 1, an impossible promise that appeals to greed. Stage 2, institutional validation that silences skeptics. Stage 3, mania that overwhelms rational analysis. Stage 4, insider exit while the public keeps buying. Stage 5, collapse, scapegoating, and systemic preservation. The fraud never stops. It just changes names and waits for the next generation to forget the previous one. Newton was a genius, but genius doesn't protect against pattern blindness. The only defense is recognizing the stages and having the discipline to exit before Stage 3 peaks. Newton couldn't do it. Most people can't. But now you know the pattern. The question is whether you'll recognize it, or whether you'll be standing in the market in August 1720, buying at the top, sure that this time is different. It never is. If you've watched this far, you understand the fraud pattern. You see how the South Sea Company in 1720 and FTX in 2022 followed identical stages 3 centuries apart. Subscribe to Capital Origins, because the next impossible promise is already forming somewhere. The next institutional validation is being purchased. The next mania is building. When you see politicians endorsing investments, when you see celebrities promoting opportunities, when you feel the fear of missing out, you'll want to recognize which stage you're in and whether the insiders are already heading for the exit. Hit subscribe. Newton's lesson cost him £20,000. Yours costs nothing except attention.